Hello and I welcome you to today's Black Friday special event here on the YouTube channel and in the live stream from JFD Brokers. My name is Jens Klatt and I'm exclusively presenting you a coaching session here around a very important topic, risk and money management. So last week we had already a first glance at the very interesting topic around behavioral finance, and you may have come across here the secret trading room from JFD Brokers, and so we were, I was guiding you through this topic, behavioral finance, based on the PDF you can find there. You can download it there, and an ebook. And first of all, here look at the risk disclaimer, and now what you may be aware of is, if you follow me for quite a while now, that I consider profitable trading be based on 3 columns here. It's not just a trading psychology. The topic here we covered last week around behavioral finance, or let's say behavioral finance is a topic here which is part of the trading psychology, but it's also based on risk and money management. Next week you will have the pleasure here with Stefan Friedrichowski, PhD in physics, who will guide you through building a profitable trading strategy. And today I decided to guide you through something which we mentioned already last week, somehow between the lines. So we may be aware of the following. Obviously, the risk and money management is very important, but so the thing is, in fact, that when I was talking about behavioral finance, I was talking about, and we will play a little game a little later during this presentation here, I was talking about something which definitely affects your overall behavior in your trading, and this is the position size. So if your position size is too high, then this obviously impacts your behavior in terms of fast profit taking, respectively letting losing trades run, since you think that you can't afford to take the loss here, realize it, and as long as the loss is a potential, it is floating, not potential, but it's floating, it's a floating loss, well, it's not realized, and then the moment it's not realized, well, it's still not real. And so this is one of the reasons why especially beginners, but also in general, some advanced traders too, tend to take out stop levels here and let losing trades run. And so let me just guide you here through this first of all. So everyone, if beginner or advanced trader, knows how important an adequate risk and money management plan is. And obviously, with a proper risk and money management plan, the chances of being profitable can be increased significantly. And here now the bridge towards this topic, having a too big position on, or putting a too big position on, it's that obviously the use leverage plays a very important role here in this context. And there was some very interesting developments here over the last year, also in Cyprus especially here, and with the CySec doing the following. They came out with a circular, it's circular number 168, subject updated version of ESMA's Q&A document relating to the provision of CFDs and other speculative products to retail investors under MiFID. And here, under 3, the use of leverage, the circular said the following: Cyprus investment firms, so-called CIFs, need to design their trading systems in a way that offer their retail clients as a default the lower leverage limit determined in the leverage policy, and give them the option, if they choose, to change the default to a higher leverage. So it is provided that the lower leverage limit is reasonable and does not exceed the cap of 1 to 50. That's the default. So what it also says is you can easily contact your broker and ask if they can raise this limit here. And let's say you get a leverage offered of, let's say, 100 to 1. or 200 to 1. Depends on the broker and how much leverage they give you here. But the reason I want to go here in further details is because leverage is such a very important topic in the world of trading in general, especially in the world of retail trading, and plays a significant role. And the CISEC, in my personal opinion, did something really great here around 1 year ago. So as you can see, that's from the 30th of November 2016. That's 1 year ago. They decided to cap this default leverage here at 50 to 1. Even this is, to be honest, it's really high. But they did a great step here, since this somehow avoids traders to fall into fall into tripping hazards. Let's call them tripping hazards here in their trading, and push the position size too high, and which will then result in cognitive biases here, which will then lead more likely to being unprofitable in their trading. By the way, 1 second please, I just have to look something up here. Okay, and so this is in fact, it's something, if the retail trader itself is not willing to take action here, because probably he thinks that it's not a big problem in his trading because he can easily cope with bigger positions. Well, I've shown you last week already that from a behavioral economics, behavioral finance perspective, it's in fact not the case. And then you probably remember those charts showing the average winning and the average losing trade, which showed that the average winning trade was about half the size of the average losing trade, which was mainly based on the fact that retail traders usually tend to use a too aggressive leverage in their trading. So, and in fact, as you can see here, this is long overdue. It is no coincidence that I, as a professional trader, money manager, trading coach, urge my students to significantly reduce the use leverage in their trading. So to give you an example here, I have plenty of requests, in fact. People coming to me and saying, hey, could you please teach me how to trade? Sure, I will do that. And then the next question is, okay, which broker do you recommend? And obviously I'm working together with JFD Brokers, so I recommend JFD Brokers as my partner broker, but also because I myself think that JFD Brokers has a great product which it offers, having no market making license, for example, so standing not on the other side of the trader, not on the other side of the trade of the client, for example, offering a post-trade transparency report, for example, so you get an overview of which order was where filled, to which price, which slippage, which liquidity provider, and all that stuff. So highly transparent here. And next question then is, okay, and what leverage do they offer? And I say, well, right now it's 50 to 1. And then they say, oh, I'm sorry, but then I think JFD Brokers is not the right broker for me. And I say, well, why? Why do you think that? Yeah, because I do not plan to trade a big account here, and that's why I have to have a high leverage offered from the broker, so that the margin requirements are low to open, let's say, a position in Euro USD, whatever. And if they say that you have to, for example, set up a position of 1 mini lot Euro USD, so 1 mini lot is 10,000 units here, Euro USD. If you therefore have to put up 200 euros in margin, it's the margin requirement. So it's 10,000 divided by 50, you get 200 euros, and that's the amount you have to put up here to open the position. So 1 mini lot. Then, well, I can't really open a big position here because I only plan to trade a 1,000 euro account, let's say, and that means that I probably can open a position as high as, yeah, let's get the spread here included too. Let's say very aggressive 4 mini lots. That's 40,000 units. So we're talking, by the way, of a so-called effective leverage of 40 to 1 here. What this is something I will describe a little later on. And that's the moment when I say, hey, just to make clear that you understand, if you really think that way right now, this is something we have to get rid of immediately, because this will kill you in no time. You have no chance if you think like that trading the markets. And then they think like, I'm kidding. No, I'm not. Because the thing is that with a too high effective leverage, chances increase dramatically that you will crash your account. And so that's one of the reasons why I, as a coach, and as a professional trader myself, by the way, so if you ask the question here, I'm sorry, what's the effective leverage I'm using in my trading? I tell you, well, something like maximum 3 to 1, which is already quite huge. So I'm trading €250,000 account, and no more. That's 300,000 already. So it's 300,000. If I say I'm using an effective leverage of max 3 to 1, we're talking about in the FX space here of me building positions up to 900,000 units, which is 9 lots. Meaning that we are very close to me opening 10 lots in face value here, and then I'm working with an effective leverage of 3 to 1. So now let's imagine I'm working with an effective leverage something like 40 or so. Then multiply my account size of 300,000 with 40, you have 12 million. So per position. So I'm setting up 120 lots here per, let's say, Euro USD or something. This is really huge. So if you want to have an overview of what this means to the pip value, we are talking in this case of a pip value here of something like nearly 1,000 euros. So yeah, it's close. It's very close, in fact. And so having this in mind, you can already see that this definitely will make something with you. I mean, I'm talking about way bigger account size, but all in all, it comes down to the same psychological problem. You will start to think in terms of money if you have a too high leverage you use in your trading. And if the leverage is very high and you plan to, let's say, trade, let's only say a 1,000 euro account, and then you open a position here where you see swings of several $100 in no time. And right now, look at the markets. Look at Bitcoin, for example. That's a perfect example. Look at the swings we get to see there. Look at the DAX right now with huge swings of something like 150 to 200 points within one day. So going up, going down. And with this in mind, you definitely see that this will do something with you, because there's a reason for you just opening an account with 1,000 euros, because you can't afford a bigger account, right? This is one of the main reasons. Some might say, okay, I'll just give it a try here and test it out with 1,000 euros and easily can put up something like 10 grand or 20 in the future here, but right now I just want to test it. But here's the question is, well, why don't you test it in the demo account, in the demo version, but want to try it with real money here to see how the early execution works? Okay, but this is something where I have to say, okay, but then you can easily, for example, work with smaller amounts here, or contact the broker and ask them whether they could send you over some stats here around the order execution time on average. And probably, if you want to go in further detail here, contact them and ask them whether they can provide you with some execution statistics here from the last non-farm payrolls event. No big deal. So a broker like JFD Brokers will easily offer this to you because they are really high end in terms of technology here. So they have there's no big problem for them. So such an argument, such a point doesn't really make sense to say, okay, I just want to give it a try. So the thing is, and that's what I want to say here, we really have to see, we really have to understand that with a too high leverage in your trading, mental problems start to develop here and will cause potential so-called cognitive biases. You remember these topics from last week from the webinar, and this will definitely cause you to act in a way which is at first glance completely human, but will cost you money in the long run if you carefully watch the components here in terms of risk and money management which affect profitability in your trading. So meaning you and this is more technical speech now, it's you are reducing the so-called expected value in your trading, cutting your winning trades short and letting losing trades potentially run, because you say, okay, I made already so much money with a trade moving in my direction, I can easily cash in the chips right now and probably double my account with no big effort. And then on the other hand, you didn't realize that you were willing to risk your whole account for this position. And with this in mind, that might probably work out once, twice, probably 9 out of 10 times, but the 10th time you will just crash your account. And this is something you have to remember. So the reason I urge my students here and everyone listening to me in my webinars to significantly reduce the use leverage in their trading is that I know that a reduced effective leverage results in a high probability to increase the chances of long-term profitability in trading. So now I've worked several times already with the word here, effective leverage. So something I'd like to make sure now that you really get this. So we are not talking about the so-called nominal leverage here, but the effective leverage. The nominal leverage is that what Circular 168 here from the CISEC talks about, which can be understood as follows. If the broker offers you a leverage of 50 to 1, it says that with 10,000 euro in your account, for example, you could theoretically trade a position up to 500,000 units. So 5 lots, and this is very easily calculated here. You just multiply your account size with the leverage offered here, which is 50 multiplied with 10,000 and equals to 500,000. So in short, the higher the nominal leverage offered by your broker, the higher the theoretical position size you can build. So imagine you're not having a broker here offering you a leverage of say 50 to 1, but 200 to 1. What does this mean? It means nothing more than you just multiply the 10,000 euros here with 200 then, and you can't just build a position of 500,000, but you can build a position of, in this case, 2 million here and trade 4 times as high as you could in here when you just were offered an leverage here of 50 to 1. So let's say, and this is something you can see here already, if a broker offers you a nominal leverage of 200 to 1, it's not just that you can build a position 4 times as high as you were initially offered by, or could by a offered leverage of 50 to 1 here, but you just have to deposit 2,500 euros in your account, so 1/4 of the initial 10,000 here, so that you can trade a position as big as 500,000 units Euro USD, because 200 multiplied with 2,500 equals to 500,000 then. Okay, so by setting the default leverage to 50 to 1 and only allow clients who have a certain level of trading experience, for example, and aware of the risk involved, the reduced leverage here results in the reduction of the potential risk for the retail trader in general. Okay, so reduction of the leverage means that you have to bring more money to trade the same amount if you really want to. Okay, so now let's come here to the effective leverage, and why does a reduction of the leverage itself increases the chances of being profitable? So how can that be? In fact, it's very easy. It's the effective leverage which comes into play. And now we'll come up with the definition of the effective leverage here. I said the position size you trade and you divide it by the account size. So for example, you plan to trade 1 lot Euro USD, 100,000 units, and your account size is 10,000 euros, means nothing more than that the effective leverage is 100,000 through 10,000 is equals to 10 to 1. So now let me just bring up the example from before with the bigger account I'm trading. So my account equals to 300,000. And by the way, 1 second, please. 1 second. I'll be back in 20 seconds. Okay, I'm back. So if my account is 300,000 euros and I say I'm working with an effective leverage of max 3 to 1, that means that obviously to get our formula here, effective leverage equals 100,000, that's the amount you trade here, and this is the account size. That means that we have 3 equals x divided by 300,000. So what do we have to do here to get this equation right? It means that I can trade, or I will trade up to 900,000 units here, or 9 lots max, when I trade FX in this case. So in fact, last time that was a trade I had on from last week on Thursday on. I was unfortunately stopped at break even last week due to this Flynn ABC Russ story around Donald Trump here. You may remember that, the huge volatility we've seen in the markets, and I was holding a dollar-yen long position, and it initially worked out really well for me, and then yeah, this story hit the wire and I was stopped out break even. But thing was that I was trading a position size of 2.5 lots here. So I've traded 250,000 units dollar-yen, meaning that the effective leverage obviously in this position alone was below 1 here. I mean, easily I could have worked with a higher position size. But now let's have a look here at the chart, what this means. So let's have a look here at dollar Japanese yen. Let's have a look here. That was, by the way, the candle I bought. That was the 13th of November here. And there's last Friday with this huge spike on the downside. So where did I place my stop? I went long around 112. In fact, it was, I think, 111.97. By the way, this is the dollar Japanese yen here. So where did I place my stop? I placed the stop here. And I said, okay, what is my account size right now? I'm sorry, yeah, that is, yeah, obviously, that's 300,000 euros. Okay, and what do I want to risk on this trade? I was willing to risk 0.6%. 0.6% equals to 2,000 euros. So risk per trade, 2,000 euros. So that means I know the amount I'm willing to lose here on this trade. That's the first question I ask myself. And then I wondered, okay, and where is the potential level to place my stop? And that was here, below this level at 110.80. So if I say entry long is 112, sorry, it was 100 and let's work with 112. I think that makes things easier. And we say place a stop here at 111.80, at 110.80. So that means that my risk on this trade here equals to 120 pips. So, okay, fine. So that means if I'm willing to risk 120 pips here, and I say the overall amount I'm willing to lose is 2,000 euros, that means that I have to take those 2,000 euros and divide it by 120. And so what you get is 2,000 divided by 120, and this equals to 1667. Okay, so now what you do, you can work with, for example, a pip calculator in the internet, wherever you might find something like that, where you can use the trading platform. You can use, for example, the so-called I can easily show this to you, by the way. 1 second. I'll just open the trading platform here. I just hope that it does not kill my capacity here. So, and by the way, while waiting for the platform to open, let me just show you this website here. It's investing.com. And there you can find a pip calculator here below tools. So this is the German thing, but you can easily adapt this here to the English side. And there you have the the possibility to see, okay, one lot, obviously here, there's a standard lot, 100,000 units, it's 888 right now, 112.65. And with this, you have a very, very easy way here to say, hey, oh, cool. Obviously, I can trade 2 lots then in this context. So as you can see, I was taking a little higher risk here. I was taking a 0.8%, I think. But you can easily see here that with 1667, you can easily calculate this here too, 8.88, and this equals to 2. That's it. So meaning you can trade 2 lots with those parameters here. If I'm willing to lose this amount of money here, and this is by the way, I'm not doing this accurately every time I enter a trade, because the more you trade and the more you have those numbers here in your mind, you just do a smart and fast calculation in your head here. But what you can see is that I start with one number I have in mind all the time. The number is the risk I'm willing to take in my trade. So this in fact defines my effective leverage here. And yeah, as you can obviously see. By the way, no. First of all, before we follow up, so first of all here, let's have a look here at the trading platform. So you can see it's not really 300, it's 280, but no, still. So the great thing is JFD offers something which is called a mini terminal here. You can download this from the website from JFD Brokers. So I just want to give you an idea where to find it. If you have any questions on this, please shoot me an email or contact me via Twitter. I can easily give this and forward this this website to you then. So okay, so this is the German website, and let's go over here to the English one. And so what you can find is here trading, and then you can click here on platforms, the MT4 in this case. So we can also use the MT5, but let's work with the MT4 here in this case, because I'm using MT4 myself. And here you have the chance of MT4 plus platform. Oh, I'm sorry. Now, one second. Let's just see whether we have a link here. Yes, here it is. You can find your MetaTrader 4 Plus experience, and there you have the exclusive JFD add-ons. And this is for free for JFD clients here, and also those who are using a demo account, so you can easily test it in a demo account here. And with this package, you have several expert advisors. Oh, yeah, I didn't want to download it. In fact, I have it obviously. So you can see here the mini terminal, for example. You can use this mini terminal in your trading and really do great things with that. So for example, if you click here, you can place an order, and you can choose between several order types here. And the great thing about this is, and here the risk comes into play, the tool calculates the risk for you. Meaning, let's say you say, I have a fixed cash risk, which was exactly what we were talking about. Then you can place here those 2,000 euros in and say, okay, that's the fixed lot size, or in this case, probably we should do that this way. So sorry, it's the other way around. It was the lot size, the fixed cash risk, and here we are working with a fixed price. So in our case for the dollar Japanese yen trade here, it was that we said, based on the lot size, I have a fixed cash risk, which is 2,000 euros, and then I place a stop loss based on the price I have, and then you can easily place the order, which we won't do here right now because I don't plan to trade in this case the DAX, by the way. Probably this changes over or in the next hours here, but right now I'm not willing to take any positions. But this is how you can do this easily. So you don't need to run this manually all the time. But if you're working with the mini terminal here, you can work with this in this context here and trade based on that. And it takes all the calculation steps here from you and automizes it. The thing is, why do I recommend to do it manually? I do this because I want to know whether I still understand what I'm doing. Sounds ridiculous, but this is the thing. If you really trade every day over and over again, you can automate this process here in your head, and then you can switch over to a mini terminal which does it for you automatically and accurately. And especially if you're a short-term trader, scalper or something like that, this is highly valuable for you. But nevertheless, I personally recommend to run those calculations in your head to make sure that you do not lose all an overview here of your overall trading and know exactly what you're doing all the time. So that's one of the reasons why I really recommend to do it that way, to understand what does the mini terminal do here in this context. So okay, I can close it here, and let's go back to the presentation. So let's come back to the effective leverage example. You plan to trade 1 lot Euro USD. That means equals to 100,000 units, and your account size is 10,000 euro. Effective leverage is 100,000 divided through 10,000. So the effective leverage is 10-1 here in this context. So, and now, how do the nominal and effective leverage interact with each other? How do they interact with each other? It's very simple. The higher the nominal leverage offered by your broker is, the higher the chances that you use it. So sounds ridiculous, but this is like putting candy in front of a little child, and yeah, what do you expect? You have a big bowl of sweet chocolate placed in front of a, let's say, 10-year-old, and then you say, okay, I leave the room right now, but please don't eat everything right now, or don't eat anything at all. Well, is this realistic? I don't think so. It's the same for the leverage. And if you want, the leverage is the cookie or the sweet chocolate here for the retail trader. If you offer him a high nominal leverage, he will definitely use it. And if he uses the high leverage, well, what he can do, by the way, I had one client, for example, who felt offended here and said, hey, I don't need someone to tell me what I should do. If I want to use the high leverage, well, I will use the high leverage, and you're not the one telling me if I should use it or not. Well, fine, no problem, and go for it, no big deal. But the thing is, I can show you something. I'm not just talking here, but I have data proving that all what I say is true. So what we can see here is, by the way, I didn't change it, unfortunately. It's still a German chart, unfortunately. But it says it's the profitable traders here in percentage here, and here on the x-axis you can find the so-called Hebel. It's in German, it's Hebel. In English, it's leverage. And what you can see is the lower the effective leverage, the higher the chances that the retail traders were profitable in their trading. So meaning if they were using effective leverage here of 5-to-1 and below that, obviously 40% of those traders in the time frame we are looking at here, which is the 31st of March 2014 till the 31st of March 2015. By the way, we are looking at a third-party broker, which we do not mention here for discretionary reasons. We are not looking at the broker like JFD Brokers. It's another broker here we're looking at, but nevertheless, it's every broker. It's the same thing. So risk aversion, or sorry, not risk aversion, the loss aversion is something you can find at every broker. One of the reasons why usually you should use tools like the sentiment offered by a broker here is or should be used as a contrarian indicator. In case of the effective leverage, it's the same topic here. So the higher the effective leverage is, the lower the chances of being profitable. So meaning if you go to the right on the x-axis here, you can see that the chances of traders dropped dramatically. So from traders using an effective leverage of 5-to-1 and below that, so to give you real numbers, meaning let's say someone opens an account of 10,000 euros, meaning if someone is working with an effective leverage of 5-to-1, then he's trading position sizes of as high as 50,000 units or below that. While someone trading with an effective leverage here of 25-to-1 and opening an account of 10,000 euros here is trading position sizes of a minimum 250,000 and higher than that. So with this in mind, well, it's no big surprise, in fact, and I will give you the example a little later, that the chances of being profitable drop and yeah, are divided by or cut in half here in this context. In fact, what we're doing here is we're looking at a huge number of trades. So just to give you an idea, we are looking at all assets, but to give you an idea, in this time span, the analyzed trades in EUR/USD alone were 9.5 million. Okay, 9.5 million trades were analyzed in EUR/USD alone, and we're looking here at a even bigger amount of data and cover many more assets here. So it wouldn't be such a big surprise to see a number of around 100 million trades being analyzed here. And for this reason alone, all what I already said around the topic of effective leverage is definitely something at least worth considering in your trading. I'm not saying that you should listen to me and just follow what I say. That's not what I say, but be aware of you making probably, let's call it mistakes, or at least being affected by a too high leverage in your trading, and this resulting in very negative impacts on your overall profitability in your trading. So yeah, that's it. That's on the effective leverage in the real world. And now let's come to an example here, which will hopefully illustrate what I'm talking about. And let's just play a game as we played last week here. Oh, by the way, that's that's a little bad. Okay, so this is the final question, but it comes down to psychological reasons once again. Okay, potential reason for leverage profitability connection. And what we want to do is we want to look at an example here. So we have a 10,000 euro account at JFD Brokers. We have 200 euro margin per 10,000 units EUR/USD, and we are both trading an identical strategy. However, we might come into the market here, it doesn't really matter. So the risk is 100 euros, or no, it's 100 pips, I'm sorry. And the take profit is set 200 pips away. Okay, so now let's look at you. You're working with a so-called effective leverage of 20 to 1, meaning if you have a 10,000 euro account, your position size equals 200,000 units. So meaning the pip value is something like 18 euros here. Now let's look at me. I'm trading an effective leverage of 5 to 1. Again, this is already very aggressive for me, and I'm also trading a 10,000 euro account, meaning that my position size equals 50,000 units. Well, while I have a pip value of 4.5 euros, so 450 here. So it's around one. Yeah, it's a fourth here. So now we both go long EUR/USD, and the position initially loses 60 pips. So it moves 60 pips against us. That means that your balance after this drop here and the market moving against you means that your margin is 4,000 euros. So this is blocked, but your floating P&L is 1,080 euros, while your free margin then goes down to obviously 4,920 euros. So somehow, if you want to adapt this to this situation, you cut your account in half, even though you didn't lose 5,000 euros, but so far you can only trade with the remaining 4,900 euros here. And this is something what I refer to here is really experience. I can say that this already does something with you, and you look at the account and you just think, okay, I not only blew 1,000 euros away, but somehow I probably get trouble here if the market keeps on moving against me, because it means probably another 1,000 euros going away, which is equaling to 20% loss of your initial deposit of 10,000 euros. And on top of that, well, it's not really close, yes, but nevertheless, somehow it feels like it's close to face a so-called margin call, and the position is closed out automatically. Let's keep it that way. And now look at my balance here. So 1,000 euros blocked because I only traded 5 mini lots here, and my floating P&L is 270 euros. In fact, this is crazy already. If you look at my trading style in general. So just to give you some other numbers. in my managed accounts, the money I manage for my clients, for example, the max drawdown over the last 14-15 months was 3.4%. And we are talking about several positions I took. So the max drawdown was less than 5%. And here in this example, you can see already me losing 270 euros, meaning that equals 2.7% loss in just one trade. So this is, in fact, for me, something which results in making me smile. So I look at those numbers and I just think I can't really imagine those numbers to be part of my day in, day out trading at all. But for giving you a better idea here of what we're talking about, let's just imagine that I would trade the way I trade. So in fact, I'm really, yeah, I have myself a very strict and disciplined risk and money management plan in my trading. And the reason for my profitability in my trading is because I take care of my losses first. And that's, in fact, the only thing I do. So, and the great thing about this is, if you do this for quite a while, at the beginning you might say, okay, but I didn't start to trade to take care of my losses, but I want to make money. The great thing about this is, but this is something you really have to strongly believe in, if you take care of your losses, the winning trades will take care of them of themselves. That's just a matter of fact. And so in this example here, you can see that 1,000 euros were blocked, 270 euros were lost so far, or it's floating P&L, and my free margin is 8,700 euros. So we are only talking about something slightly a little more than 10% of the overall deposit of my account, which yeah, it didn't go away, since I mean those 1,000 euros here are only blocked, but I have definitely way more room to breathe here and to, yeah, to stay calm. Nothing happened so far. I mean, it's a strategy. I know it's profitable. That's the next thing. Something which will be presented from Stefan to you next week. The great thing is, if you know what you're doing, if you know your strategy, you have no real problem here, in fact, to stay calm, because you know, even if I lose now in this trade, which is likely, by the way, if a market moves 60 pips against you, and you're giving it room for 100 pips. I mean, I'm not saying it's 100% sure, but let's say if you had a good trade on, the great thing is, and this is something you will find out with experience here, well, the thing is that if the market moves in your favor right from the beginning, it is highly likely that you're in a very, very good spot here and looking at a very profitable trade. If it moves against you and more than 50% of your initial loss, the chances are highly likely that this will be a losing trade. And the thing is, in fact, that here we can already start to take action. For example, taking out half the position. That's something we call scale out. The only problem is I can work with this, since it means if I scale out here on this position, taking out half the position because the market is not moving my direction, and having a clear target in mind, making sure that with the knowledge that this trade will potentially be a losing trade, taking on half of the loss right now, and if the market moves another 40 pips against me, I'm only losing those 40 pips with half of the initial position size here. Well, the thing is that I can easily say, hey, you know what, I'm taking out 135 euros here, I'm losing it, okay, fine. But just imagine you have to do the same, and you have to realize a loss of more than 500 euros. So you have to realize half of the position here, the loss already, and seeing 5% of your overall account just going away, with you having to decide, am I willing to take out half of the position here for 5% of my account? Well, the answer in most of the cases is definitely no. You just don't think about trading in terms of expected value anymore. That's just not the way people behave here, especially beginning trades. And assuming here that they know what expected value is. Okay, that's the first step. But exactly this, what I'm talking about here is you really have to understand those basic rules, and you have to step back from getting emotionally involved in your trading, which is unbelievably difficult here to achieve if you're trading with a too high effective leverage, respectively a too big position you initially put on. So now some might say, and this is usually what happens, people come up with, okay, but we are only all the time are talking about losing trades. Could you please tell me what happens in case of the market moving in my direction? That means I'm making 4 times as much money as you will make. Yes, that's fair. It's a fair point, but the problem is, now imagine the market moving 60 points in your direction, or 60 pips in this case. So you're not seeing a floating P&L of minus 1,080 euros here, but having a plus of 1,080 euros. So are you really willing to keep this position up and try to make another 60, 140 pips as initially planned here? Well, we placed the take profit at 200 pips away, not 60 pips away. So will you really keep this position up? I don't think so. That's something what my experience tells me. So you will just cash in the chips here and say, okay, there will be another chance to then try to make up for potential further move on the downside. While I can in fact stay with my winning trades easier, because I say, hey, I only made 207, in this case 270 euros. It sounds ridiculous. In fact, it's 2.7%, and also this is something which is a huge number for me in terms of performance here, but I can easily stand with my position, in fact, and make up for here. I mean, and that's something you have to remember. If I make another 140 pips here on this trade, I will somehow come out somewhere where you cashed in your chips while having only, in this case here, having a fourth of the initial risk. And in fact, you won't have you won't have a winning trade in front of you all the time. So in fact, you can easily reverse this concept here of losing to the case of winning, and see that all in all you will, or you tend to cash in your chips faster and cut your winning trades short, which is something you should definitely avoid in trading. Everyone knows letting winning trades run and cutting losing trades short is what profitable trading is about. But if you trade too big in relation to your traded account, it's something which is very, very difficult to achieve. And so let's sum all this up, what I presented to you here. So first of all, the decision of the SISIC here 1 year ago to reduce the nominal leverage is much appreciated, especially for professional traders. And I've spoken to several professional traders which really applauded and said that was long overdue, in fact. And the nominal and effective leverage are tightly connected to each other, which means if a broker is capable of offering a high nominal leverage, the trader, especially the unexperienced one, is very likely to use it, like a child will eat all the candy at once after you left the room. And really, that's just the candy for the retail trader, the high leverage. And this increases the chances of going broke fast significantly here. And so even if the SISIC, in fact, and if you read this statement carefully 1 year ago in the circular number 161, offers the chance for more experienced traders especially to adapt the leverage and use a higher leverage. So sending a mail to the broker and asking for giving the chance to trade with a higher effective leverage here, or higher leverage in general, even if this is possible, I recommend one thing: don't request it. Well, 50 to 1 is enough, and definitely something you will be really thankful for, because, and this is something you will find out after starting trading. If you're a beginner right now and think about starting trading right now, it's definitely something you will be thankful for. Because you will find out that trading with a too big position size in your trading, or right from the start, is something which will affect your trading in a very negative way. You will have big trouble to let winning trades run and cut losing trades short. And it comes all down to, in fact, the first presentation 1 week ago in terms of behavioral finance here and behavioral economics, where those cognitive biases played an enormous and very, very crucial and important role.
And yeah, so that's it from my end. I hope you enjoyed this presentation. If you have any questions, please shoot me an email. Shoot an email over to JFD Brokers. Contact me via Twitter. We have several ways of interacting with each other here and talking with each other. I definitely look forward to it. And yeah, as I already said, I just hope that you enjoyed the presentation. Next week it will be the third column of profitable trading, building an advantageous profitable trading strategy. And this webinar will be held from Stefan Frichowski, PhD in physics. Highly recommend to listen to him too. And yeah, and that's from my end. So happy trading all the time. Watch your stops, and hope to see you on several webinars, upcoming webinars here. That's from my end. So see you, and bye-bye.